Okay, hi everyone. Today we are going to start a new chapter, chapter 6, inventories and cost of sales. Of course, we know that merchandise inventory, it's a type of current asset and it's recorded in the balance sheet. What about the cost of sales? Actually, we know that when we purchase any asset, it's recorded in the balance sheet as an asset. However, when I start consuming this asset, I start using this asset, it's converted to an expense. So when the merchandise inventory is purchased, it's recorded as a merchandise inventory in the current assets in the balance sheet. However, when I start consuming or using it, by consuming here, I mean that I start selling it. I'm selling my inventory that I purchased in order to resell it. So when I sell this inventory, it's converted to an expense called cost of goods sold or cost of sales as it's named in the title of the chapter. And it's recorded, of course, in the income statement because it's an expense. Cost of sales or cost of goods sold, it's an expense. So it's recorded or it's presented in the income statement. So again, as we used for any asset, when I purchase it, it's recorded as an asset. When I start using it or consuming it, it's converted to an expense. Of course, we have talked previously in last semester about the merchandise inventory and the cost of goods sold when we started chapter 5, or when you took chapter 5 at the end of the last semester, accounting for merchandising companies or merchandising operations. You know that a merchandising company, its main activity is to purchase inventory in order to resell it. So we have taken two different inventory costing systems, perpetual and periodic, that the merchandising company has the freedom to choose this or that. The difference between the perpetual and periodic system, as we just explained in the previous semester, that for the perpetual system, from its name, we require to have continuous record for the cost of goods sold after each transaction. However, for the periodic system, we just calculate the cost of goods sold at the end of the accounting period. And we have taken also the cost of goods sold, and when we just going to record any sale that happened, any sale transaction, under the perpetual system, we need, as we said, to record an entry for recording the revenue and another entry for recording the cost of goods sold. This is in the perpetual system because we need continuous record for the cost of goods sold after each transaction. Okay, so again, I'm going to say that we have two different inventory costing systems. What we are going to talk about thoroughly in this chapter, that we want to know how to calculate the cost of goods sold. We have known cost of goods sold last semester, but when it's calculated as it is, and I just record it in the entry under the perpetual system for a sale transaction. However, today in the chapter, we want to know how to calculate the cost of goods sold. So we are going to talk about different inventory costing methods that the merchandising company has the freedom to choose any of these inventory costing methods that we are going to speak about or talk about. So any merchandising company should determine three issues, or should be concerned about three issues. Number one, what costs to be included in the inventory. As I said before, the cost of the inventory should include all the costs I incur in order to have this inventory ready for sale. The same as what we said for the plant assets, that for the plant assets, I should record the plant assets with all the costs I incur in order to have this plant asset ready for use. It was for use. However, here in the inventory, I say all the costs incurred in order to have this inventory ready for sale. So it's not just the price that I pay at the beginning when purchasing this inventory, but also, for example, if there's cost of transportation, if there's cost of packaging, cost of training. For example, if this inventory or this product require some training sessions for my sales rep in order to explain for the customers how to use this product, for example, any costs I incur in order to have this inventory ready for sale should be recorded under the cost of the inventory in the balance sheet. So this is number one that the company should be concerned with. What costs to be incurred, what costs should be included for the cost of inventory. Number two, what inventory should be added and what should not be added. What I mean by this, if you remember that we have we had taken previously different transportation terms, FOB shipping and FOB destination. And we said that if the agreement between the buyer and seller FOB shipping, so the buyer should add the cost of the inventory in his own inventory while it is on transit, while the inventory is on the way for the buyer. It is his own responsibility. The ownership is transferred to him when this inventory is on transit. So for the buyer, he should add this inventory in his own inventory. However, the seller not. And another agreement or another term is the FOB destination, when the seller pays the transportation cost and he is responsible for the goods until the goods arrive to the buyer's destination. So according to these different terms, and also according, for example, if there's something called goods on consignment, so we will know if the goods on consignment will be included for the consignor or the consignee, and so on. We'll explain this in details in just a few minutes. So number 2, for any merchandising company, that they should determine which inventory to include and which should not. So number 1, what cost should be included for the inventory? Number 2, what inventory should be included in my own inventory or not, and what should not be included. Number 3, what inventory costing method I'm going to use. This is the main topic for our chapter, the different inventory costing methods, which are, we are going to explain them in a few minutes, which are FIFO, LIFO, weighted average, and specific identification. The company had the freedom to choose any of these inventory costing systems, costing methods. And of course, to choose the inventory costing system, they are following: whether perpetual system or periodic system. Okay, let's start with exercise 1, inventory ownership, saying that at year end, Harris Corporation had shipped $12,500 of merchandise FOB destination to Harlow Corporation. Which company should include the $12,500 of merchandise in transit as part of its year-end inventory? Okay, here Harris is the seller, shipped some merchandise inventory to Harlow, so Harlow here is the buyer, and the agreement between them is FOB destination. The agreement for the transportation, for paying the transportation cost, is FOB destination. FOB destination, we said before that for FOB destination, the seller is the one responsible for paying the transportation cost, and also the seller is responsible for the goods when it's transit, when it is on its way for the buyer to arrive to the buyer destination. So it is the responsibility of the seller until it arrives to the buyer destination. Accordingly, here, when the goods is in transit from Harris to Harlow, which of these two companies should include the 12,500 of inventory that in transit in their own inventory? Of course, Harris company is the company that should include the 12,500 of merchandise in transit as part of its year-end inventory. Since Harris is the seller and the agreement is FOB destination, so it is still in its own responsibility till the ownership is transferred to the buyer when it arrives at its own destination. Okay. Unlike for sure the FOB shipping. FOB shipping is the buyer is the one who is responsible for paying the transportation cost and the one responsible for the goods when it's in transit, as long as the goods are out of the company's as long as the goods are out of the seller's company. Okay, let's move to exercise 2. Subject, not exercise 2, the same exercise but number 2. Exercise 1, we are still in exercise 1 but number 2. Harris Company has shipped $20,000 of goods to Harlow Corporation, and Harlow Corporation has arranged to sell the goods for Harris. What does this mean? That Harris gave some goods to Harlow Corporation that wants Harlow Corporation to sell this goods for Harris. Identify the consignor and the consignee. The consignor here is Harris, since Harris is the one who shipped the goods for Harlow Corporation in order to sell these goods for them. The consignee is Harlow Company, since Harlow Company is the company responsible for selling the goods for Harris Company. Which company should include any unsold goods as part of its inventory? Of course, Harris Company is the company that is should include any unsold goods as part of its inventory, because the consignor is is still having the ownership for the goods. He just gives these goods to another party to sell them for him in its store or whatsoever. However, it's still the ownership with the consignor, since these goods are their own goods, so it should be counted in their own inventory. Okay. Exercise 2. Inventory cost. Warburg Associates Antique Dealers purchased the contents of an estate for $75,000. Terms of the purchase were pop shipping point, and the cost of transporting the goods to Warburg Associates warehouse was $2,400. Warburg Associates insured the shipment at a cost of $300 prior to putting the goods up for sale. They cleaned and repaired them at a cost of $980, which is necessary to make the goods ready for use. Determine the cost of the inventory acquired for the we need to determine or calculate the cost of inventory. Again, as I said, that the cost of inventory should include all the costs the company incur in order to have these goods ready for sale. So let's see here, cost of inventory. First, the price of the inventory, which is $75,000. Then the transportation in $2,400. Since the agreement is pop shipping, so the buyer is the one responsible for paying the transportation cost. Also, insurance on shipments $300. Cleaning and repairing $980, since it said that they cleaned and repaired the inventory at a cost of $980, which is necessary to make the goods ready for use. And we said that we should include all the costs the company incur in order to have the goods ready for use. So finally, we'll have total cost of inventory $78,680. Okay. Let's move to another exercise. Actually, this exercise is the main theme for this chapter, which talking about the inventory costing methods. As I said, there are different inventory costing methods, and the company has the freedom to choose any to apply for calculating the cost of goods sold and cost of ending inventory, on condition that the company should be consistent as long as the inventory costing method is suitable for the nature of their products or inventory. Okay, let's see here. This exercise says that Werner Wood Company uses a perpetual inventory system. It entered into the following purchases and sales transactions for March. For specific identification, the March sale consisted of 8 units from beginning inventory and 3/4 units from March 5 purchase. The March 29 sale consisted of 40 units from the March 18 purchase and 120 units from March 25 purchase. And we have here a table consisting of the date, column for the date, column for the activities, either beginning inventory or sale or purchase, and a column for units acquired at cost, how many units acquired and how much cost per unit, and final units sold at retail. And by retail I mean the selling price, how many units were sold and at how much selling price per unit. And the totals here for the units in the last row. Required here to compute the cost of goods sold and ending inventory under the following methods. What are these methods? There are the different inventory costing methods, either FIFO, first in first out, LIFO, last in first out, weighted average or recorded average cost method, or specific identification. Let's briefly differentiate between these different inventory costing methods. For FIFO, first in first out, if we take it from the perspective of the physical flow of the products, so by first in first out, I can say that this method is applicable or suitable for type of companies that having a certain type of or certain nature for products that are, for example, having expiry dates, food products that have expiry dates, like cheese, milk, yogurt. So I can apply for its physical flow to be sold in terms of first in, first out. The first product that I said are the first one that should be sold. Also, we have last in, first out, LIFO. In LIFO, this inventory costing method is applicable for products such as wine, perfume, in which the longer they stay, the better quality they will have. So it's applied the physical flow to be LIFO, last in, first out. Weighted average or average cost, for example, like companies in which the main activities, for example, digging in a well or a mine. So in the mine we have, for example, different kinds of oil. So I want to take an average cost for this different kinds of oil. And finally, specific identification, which is the most easiest one, in which this is applicable for the antiques, or for example diamonds, a certain precious tableau. So each item has a specific cost related to it. That's why it's called specific identification. Each item has a specific cost identified to it. And I said that this the most easiest one, since as you can see here in the exercise, there should be some info related to the sale in order to determine the sold units are from which day, to know the cost, whether the cost is from the beginning inventory or from the units purchased on day 1, 2, 3, whatsoever. Okay, let's see how we can solve or calculate the cost of goods sold and ending inventory using these 4 different methods to understand them well. Let's start with FIFO, first in, first out. If I want to calculate cost of goods sold and cost of ending inventory using FIFO under the perpetual system, remember that in the problem it stated that the company is under the perpetual system. First of all, I need to make a table consisting of these 4 columns: column date, column goods available for sale, which is consisting of the beginning inventory along with the purchase, cost of goods sold, and ending inventory. Okay, for the first day, March 1st, I have beginning inventory with 100 units at a cost of $50 per unit. Then on March 5th, I purchased 400 units at a cost of $55. On March 9th happened a sale. There is a sale on March 9th in which 420 units are sold. At how much cost? Concentrate here. We are using FIFO, first in, first out inventory costing method. So the 420 units, I can take their cost first from the 100 units on March 1st. 100 times $50. I want to complete them to be 420, so I take the rest, which are the 320 units from the 400 units purchased on March 5. So 320 at a cost of $55. Okay, so the remaining inventory will be as follows. The 100, nothing is remaining from this since I took them all. From the 400 units, I took only 320, so the remaining units will be 88 units at a cost of $55. Then moving to March 18th, I purchased 120 units at a cost of $60. Then on March 25th, I purchased 200 units at a cost of $62. On March 29th happened another sale transaction in which 160 units were sold. From where do I take the cost of this 160 units? As long as I'm following FIFO, first in, first out. So I'll start by taking the 8 units that were remaining here on March 9. So 80 times $55 per unit. However, I sold 160, so I need to complete them to 160. So there are remaining 8 units. I'm going to take them from March 18th at a cost of $60. How about the remaining total 160 units sold? How many units remaining? Actually, from the 120 here, I took only 80 units, which means that 40 units are remaining at a cost of $60, and the 200 units are all remaining since I did not take anything from them, so So 200 units at cost of $62. Okay. Having a total for the cost of goods available for sale 46,600 when I add all this column, and for the cost of goods sold I add these four numbers to have 31,800, and for the cost of ending inventory here are the remaining costs for ending inventory. I add these two numbers, 14,800. I want to make sure that I'm on the right track. I just add these two numbers, cost of goods sold and cost of ending inventory. If they give me 46,600, the cost of goods available for sale, so I'm right. I'm on the right track. Since this is the main equation and most important equation, I need you to know cost of goods available for sale equal cost of goods sold plus ending inventory. It's important to know this equation even for MCQs and true or false and so on. So it's a double check for me to make sure that I'm on the right track. If I do not find them equaling to the total cost of goods available for sale, then there is something wrong that I went through while solving. I need to repeat it once more again. Okay. Let's move to LIFO under perpetual system. The same table with the same headings for the columns. Starting by the first day, March 1st, I have the 100 units beginning inventory at a cost of $50. Then I purchased 400 units at $55. Here in the 9th of March, on the day that I have a sale, I sold 420 units. But take care that we are using here LIFO inventory costing method. So when I'm going to calculate the cost for the 420 units, I'm going to start with last in first out. I'm going to start with the 400 units. So I will take all the 400 units at a cost of $55. Then I want to complete them 420, so I take the remaining 20 units from the 100 on 1st of March beginning inventory. So I will have 400 units at cost of $55 and 20 units at cost of $50. On March 18th, I purchased 180 units at the cost of $60. Then on March 25th, I purchased another 200 units at the cost of $62. On March 29th happens another sale transaction, which I sold 160 units. But again, remember here that I'm following LIFO, I'm using LIFO inventory costing method. So the 160, I'm going to calculate the cost based on last in first out. So I'm going to take the 160 from the March 25th from here. So the cost will be $62 per unit. 160 units times $62 per unit. How about the remaining inventory? Actually, here from the 200 I took only 160, so the remaining will be 40 units times $62 per unit. The 120 I did not take anything from it, so as it is. 400 I did not take anything from it, so as it is. And also the 100 units I did not take anything from it, so as it is. Making a total for cost of goods available for sale 46,600, cost of goods sold 32,920 when I add these three numbers, and the cost for ending inventory I add these four last numbers, giving me 13,680 and cost of ending inventory. And to make sure that I'm on the right track, I just add these two numbers, cost of goods sold and inventory, ending inventory. That will give me 46,600 cost of goods available for sale, to make sure that I'm on the right track. Actually, the cost of goods available for sale will not differ under any of the four inventory costing methods. The thing that differs is the calculation for the cost of goods sold and the calculation for the cost of ending inventory. Okay. Let's move to the weighted average under perpetual inventory system. Starting with the same table and the same columns. On March 1, I started with 100 units and a cost of $50. Then on March 5th, I bought 400 units at cost of $55. On March 9th happened a sale transaction. When solving under or when solving using weighted average method, I stop after the day of the sale. After the day that happened sale transaction, I stop after it and I calculate the average cost per unit. So since March 9th happened the sale transaction, I stop at March 5th, the previous day, in order to calculate the average cost per unit. So here I have 100 units cost of $50 and 400 units cost of $55. Calculate the total of the units. I am having 500 units in total, and calculate the total cost. I have in total cost 27,000. So to calculate the average cost per unit, I just divide the total cost with the total number of units, having $54 average cost per unit. This number, the average cost per unit of $55, is the number that I'm going to use it on March 9th, the day of sale, in order to calculate the cost of goods sold and cost of ending inventory. So here, 420 units were sold on March 9. I'm going to multiply by the average cost per unit I've just computed here, $54. And for the remaining units on March 9, I was having 500 units in which I sold from them 420 units, so the remaining units will be 500 minus 420, remaining 80 units at a cost of $54. So again, when there is a sale transaction, I stop before it in the previous day and I calculate, I find how many units do I have and how much cost for the units I have, and I just divide the total cost with the total number of units to arrive at the average cost per unit. And this average cost per unit I computed in the previous day is the number or the cost that I'm going to use it on the day of sale, whether for calculating cost of goods sold I multiply by the number of units sold, or for the ending inventory I multiply by the remaining number of units in ending inventory to arrive or to calculate the cost of ending inventory. I multiply the number of units remaining times the average cost per unit I've just computed here in the previous. On March 18th, I purchased 180 units at a cost of $50. On March 25th, I purchased 200 units at a cost of $62. But stop here because on March 29th there is a sale transaction, so I stop again the day before it to calculate the average cost per unit. So here I have 80 units at $54 per unit. Here, the remaining ones here. Then I purchased 180 at the cost of $60. Then I purchased 200 at the cost of $62. So the total number of units I have are 400 units, and the total cost I have 23,920. So to calculate the average cost per unit, I just divide the total cost divided by number of units to arrive at $59.80 cost per unit. This number, the average cost per unit, is the number I'm going to use it on the following day in which the sale transaction happened, March 29th, to calculate cost of goods sold. So here 160 units were sold. I just multiply the 160 units sold times 59.80 I've just arrived to at the previous day when I calculated the average cost per unit to arrive to the cost of goods sold. And for the ending inventory, just see how many units are remaining. I was having 400 units in which I sold 160 from them, so the remaining units are 240 units. I just multiply by the average cost per unit I just computed on the previous day, which is 59.80. So again, when there is a sale transaction and we are following weighted average inventory costing method, I just stop on the previous day to calculate the average cost per unit. I find how many units I have, how much are their cost, and I divide the total cost with the total units to compute the average cost per unit. This average cost per unit is the number I'm going to use it on the day of sale, the following day, which is the day of sale, in order to multiply by the number of units sold to arrive to the cost of goods sold, and multiplied by the number of remaining units to arrive to the cost of ending inventory. Having the total of cost of goods available for sale as it was in the previous two methods, 46,600, and the cost of goods sold 32,148, and the cost of ending inventory 14,352. Again, when I add the cost of goods sold and cost of ending inventory, this should be equal to the cost of goods available for sale, which is 46,600, to make sure that I'm on the right track and nothing went wrong with me as well. Okay. let's move to specific identification. As I said before, the specific identification is the most easiest one for them because it's given for me a certain info to help me in calculating the cost of goods sold and cost of ending inventory, in order to help me to know the cost per unit for the units sold and the units of ending inventory. So let's start with first calculating goods available for sale. Because the goods available for sale is equal to the cost of goods sold plus ending inventory. So I can arrive first to the cost of goods available for sale. How? By just having beginning units times cost price plus purchases times cost price to arrive to the goods available for sale. So I have 100 units beginning times $50 per unit plus 400 purchase times $55 per unit and 120 purchase times $60 per unit, as well as 200 purchase times $62 per unit, arriving to the cost of goods available for sale $46,600. Again, the same as we calculated in the previous three methods. Okay, then I want to arrive to the cost of goods sold. How to arrive to the cost of goods sold? I have 80 units from beginning inventory. It's given to me in the problem. 80 units from beginning inventory, which means at the cost of $50 per unit, and I have 340 units from March 5 purchase, which means they're having cost of $55 per unit, and I have 40 units from March 18 purchase, which means that I have that the cost is $60 per unit, and for 120 units from March 25 purchase, which means that the cost per unit is $62 per unit, arriving to cost of goods sold $32,540. Then the ending inventory, I just deduct the cost of goods sold. I arrive to the $32,540 from the $46,600 total goods available for sale to arrive to the cost of ending inventory. Again, we should always remember and put in our mind this important equation: cost of goods available for sale equals cost of goods sold plus ending inventory. So if I have calculated cost of goods available for sale and I calculated the cost of goods sold, it will be easy for me to know the ending inventory by just subtracting cost of goods sold from cost of goods available for sale. And any of these are known and someone is unknown, some item is unknown, it's easy for me to know it by substitution in the equation mathematically. Okay. Okay, moving to requirement number 2, compute the gross margin under the four methods, the four inventory costing methods: FIFO, LIFO, weighted average, and specific identification. Comment as to which method gives the higher profit and why. Okay, of course we know that sales minus cost of goods sold gives us the gross margin, and then I deduct some expenses in order to arrive to the net income or the net profit. First, I need to calculate the sales. How do I calculate the sales? As I told you at the beginning, that I multiply the units sold times the selling price per unit. So I have here 420 units sold times $85 per unit, plus the 160 units sold times the $95 per unit, which will give us the total amount of sales of $50,900. Okay, I'll just insert the sales as this table. Then I will find the cost of goods sold, which I already calculated previously in the previous slides. If we go back, I will find that the cost of goods sold under FIFO will be $31,800. So this will give us a gross profit of $19,100. Before completing, by logic, do you think which method will give us the higher profit? If we are in a period of rising prices, so automatically, if I'm following or if I'm using first in, first out, this means that when I calculate the cost of goods sold, I will use the lowest costs in the past. So the cost of goods sold will be the lowest, and automatically this will yield the highest gross profit and net profit if I'm using FIFO. Okay, let's see, in order to confirm this result that I just told you, that FIFO will give us the higher gross profit. Under LIFO, I have the same sales, the sales will be the same. less cost of goods sold that I already calculated previously in the previous slides, which gives us 32,920. This gives a gross profit of 17,980. Then weighted average, the sales is the same, 50,900. Let the cost of goods sold that were previously calculated, $32,248, which will give us a gross profit of $18,652. Finally, the specific identification, I have the same sales, 50,900, less the cost of goods sold, 32,540, which gives us a gross profit of 15,360. Let's see which one will give the highest gross profit. As I just told you at the beginning of solving this exercise, it will be 5. When I told you before, even solving and calculating, it's 5. Logically, because if we are in a period of rising price, and this is the usual case, we are always in inflation, this means that first in, first out. The first item I sold in the past will be first sold. So when I'm going to calculate the cost of the goods sold or the item sold, I will use the lowest cost in the past. This will give us the lowest COGS or automatically the highest gross profit and net profit. So I can comment here that LIFO will the method that gives us the lower gross margin, as it will yield the highest COGS, as you can see here. So it's 2,920. Why? Due to selling the most expensive units first, last in, first out. The last units I sold now will be of the highest prices, since we are the period of rising prices. The prices are increasing. So this will give us the highest COGS and automatically the lowest gross margin. Okay. Let's move to exercise 4. Exercise 4, it's about different inventory costing methods. This exercise states that it's required from you to match the inventory valuation method from the list below that is being described in each situation in letters A through E. In all cases, assume a period of rising prices. And we have here in the table FIFO, first in, first out, LIFO, last in, first out, and weighted average and specific identification. And these are the different four inventory costing methods that we have taken in this tutorial. Okay, the first one, the method that is used if each inventory item can be matched with the specific purchase and invoice. We have here a keyword, as we can see here, specific purchase. So it's going to be specific identification. Okay, we have said that for specific identification we have the items identified specifically for each item, what is its purchase price or what is its cost for the specific identification. That's why this is specific identification, and we have examples for this. For example, something like the antiques, a piece of diamond, certain tableau that has certain specifications, so the price is identified specifically for this item. Okay, the second one, the method that will cause the company to have the lowest income taxes. Let's think about it. We write here this equation that we have taken in the previous semester when we were preparing the multiple step income statement for merchandising companies. So we said sales minus cost of goods sold gives us the gross margin. Then I deduct from the gross margin other expenses in order to arrive to the net income. And the taxes are paid to the government as percentage from the net income. So here, if we are in a period of rising prices, the prices are increasing, so the cost of goods sold will be, I'm going to, if I'm following LIFO, so I'm going to sell the products that were purchased last, at the end, first. So the cost of goods sold, if I'm going to calculate the cost of goods sold, it will be calculated based on the high prices, since we are in a period of rising prices. So the cost, we are going to have the highest cost of goods sold, leading automatically to the lowest net income, since both are inversely proportional to each other. So having the lowest net income indicates that we are going to have the lowest income taxes, since I said that the taxes are calculated as a percentage from the net income. So here it's going to be LIFO, last in first out, is the method that will cause the company to have the lowest income taxes. The following one, the method that will cause the company to have the lowest cost of goods sold. If I'm following FIFO, first in first out, so the item that I purchased in the past is going to have the low prices, since I'm in a period of rising prices. So the items purchased in the past is going to have the low prices. So automatically we're going to have the lowest cost of goods sold if we are following FIFO. So FIFO is the method that will cause the company to have the lowest cost of goods sold, according to the old prices that were low in comparison to now the high prices, since we are in a period of rising prices. Finally, the last one here, the method that will tend to smooth out erratic changes in costs. I mean by erratic changes, the irregular changes. So it's going to be the weighted average, since I said in the weighted average method we just calculate the average cost for different items. So it's called the weighted average method, or the average cost method. Sometimes we call it the average cost method. So this exercise is like a brief summary for the different inventory costing methods we have taken: FIFO, LIFO, weighted average, specific identification. I just need to remind you again that there is difference between when I'm using these different inventory costing methods from the accounting perspective for calculation just in my accounting books, and from the physical flow. If I'm concentrating or concerned with the physical flow, the matter will differ. For example, it will depend on the type of product. For example, if I'm company selling food products, products that have expiry dates like the milk, yogurt, cheese, so I'm going to follow FIFO, first in, first out. However, if I'm selling products like the perfumes, we know that the perfume, the longer it stays, the better its quality, or the wine, so I'm going to follow LIFO, last in, first out. This is if I'm going to be concerned about the physical flow. However, what I'm concerned about it here from the accounting perspective, calculating the cost of goods sold and cost of ending inventory using these different inventory costing methods.